if everything works well in a portfolio, then that means you're not really diversified. At best, you want 80% of your positions to work well and 20% to not work well.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Perfect. All right. Well, thank you. Welcome to another episode of Finances Podcast. By extension, this is our quarterly market update. Again, joined by JT from InvestSense. So, welcome back again, JT.
Thank you for having me, Ben.
Again, we'll try and keep this pretty short and sharp and punchy. We'll try and hit on a few topical things that have been floating around in the media, and no doubt we've all come across. So maybe we'll start off with the US. I think that's our normal theme. So let's continue that theme and sort of get a feel for where things are at, and maybe some of the recent data points or points of interest coming out of there.
Yeah, sure. So just let's start with a bit of a performance year to date. Now that we're coming to the close of 2025, surprisingly, if you look at the returns of the S&P 500 or even of the Nasdaq, they actually haven't performed that well compared to other markets. They've outperformed the Australian equities by a little bit, but they don't compare very favorably with Japan, emerging markets, and Europe in particular. And that's been a bit of a change from previous years. And as you know, and hopefully some of our clients know as well, is that's kind of how we've been positioned for the last few years, really, where we were underweight the US and overweight those other markets. And so for the first time in a few years, this actually worked out really well for us. Now, this is only half the battle and half the story, because if you dig a little bit deeper, within the US, there's actually two underlying trends happening. One is the very large cap and particularly AI-driven companies. So that might be, the likes of NVIDIA and Microsoft and Google, Amazon, etc., but also other companies that are more in the mid-cap and small-cap space that are connected to that AI supply chain, have continued to do very, very well. And everything else has been neglected by the market. So that kind of led us at an investment committee level to have a bit of a discussion around is there a bubble in AI? And that's a topical conversation that you'll find everywhere. Now, the way I wanted to frame the conversation is, first of all, acknowledge that this leaves the realm of analysis and enters the world of subjective opinions, right? So let's not treat anything we say here too seriously. At the end of the day, it's kind of having trying to have a crystal ball and reading to the future, and no one really knows. But in trying to inform that conversation, we've looked at a little bit of data around capital expenditure, essentially how much those big tech companies that have been tech champions for close to 20 years now, right? The likes again of Google, Amazon, and Microsoft, and the owner of Facebook, Meta. Those companies have typically been very capital light. In other words, they don't invest a lot of money in order to provide the services that they do, right? Google, at the end of the day, is a search engine. It's an algorithm, right? The most that Google spends is probably on people, engineers, and when you compare that to large industrial firms that have to build their manufacturing plants, etc., they were always very capital light, and a lot of their value was in their intellectual property. And the debate in prior years, if you go back to 10 years ago, was how do you value that intellectual property? And the market was already assigning quite a high value to it. And with the benefit of hindsight, we can say now rightfully so, because they were able to derive a lot of earnings from that intellectual property, right? You use the example of the search engine of Google, that formula turned out to have been very revenue generating, made a lot of money for them and for their shareholders by extension. Today, those companies have a very different profile, because over the last few years, and even more so projected into the future, they're actually spending a lot of money into building data centers, which they need in order to train their AI models, and in order to sustain the use of their AI model by more and more customers, right? Now, at the core of those data centers are NVIDIA chips that are extremely expensive. I think that they represent about 60% of the overall cost of the data center. It's just the chips that power them. And again, here, there's no right or wrong. I mean, we don't know whether this is going to be a good investment or not. What we wanted to highlight is the fact that the risk associated with those companies has changed, right? From being purely a risk of valuation around how do you value that intellectual property to now that they're spending a lot of money. They're actually, for the first time, borrowing a lot of money as well. So all those companies are issuing bonds in order to fund those investments. Their risk profile has changed to companies that are going to be more in debt and where shareholders are going to see or going to need to see a return on the investment. And that's where the big question mark is. Now, hopefully I haven't confused too many people. I haven't provided a lot of answers, but I think if we reposition that conversation within the portfolio itself, right? How does it impact what we do? Well, in a world where they're going to see earnings following those investments, then any exposure to the U.S. more broadly, but in particular to the U.S. tech sector, should do well for investors. In a world where not, then obviously any exposure to that is at greater risk, and it's very much of a binary approach. And I think what we discussed was that even if there is a bubble and that bubble pops at some point, it is fairly unlikely that we'll be able to see in advance that bubble, about to pop and reposition the portfolio. That kind of like trying to time the market is a bit of a fool's errand. And so what we've done over the years and our positioning really hasn't changed that much is to try to maintain some exposure to those magnificent seven, to that AI thematic, but definitely less exposure than the broader market. And so just like in previous years, not in 2025 because of what I mentioned earlier about Europe, Japan, and emerging markets, but in previous years we've lagged the market. But we also think that on the way down we should be able to cushion the fall a little bit. We'll definitely have some negative returns in line with equity markets, but hopefully we can cushion the fall. And then that's where the heavy lifting of the work will have to be done is rejig the portfolio in order to benefit from the recovery that inevitably will come after that. So that's kind of the conversation we had talking about AI bubble and the portfolio. And really, what I wanted to touch on with you is how do we make sure that our clients are aware? We manage the expectations around what the portfolio can do, both on the way down and on the way up. As every investment cycle will see ups and downs.
I think the interesting thing and where people sometimes get caught up in investing is like in absolutes in terms of being in or out altogether. And I think that the key thing is that it's about just weighting and exposure levels in that. So, when we're talking about AI or US or any of these markets, sectors and areas, you do the analysis and you don't exit entirely. You just may not be as positioned as heavily in that sector. And that's the thing is we've had plenty of exposures to the US and to these AI and the big companies. We probably haven't just been as aggressive as some other parties have been or some indexes have been. So in recent times, that's worked quite well. There's been times where it's lagged, but I suppose trusting the fundamentals and the analysis and the valuation methodology longer term, that's what we trust and that's what we hold up. And I think definitely when clients would be able to attest to this is when they see the market maybe in a bit of a pullback period, we haven't tended to see that as aggressively in the portfolios. And yes, it's about we're still going to feel some, but we're not going to feel quite as much of it, which is nice.
Yeah, no, absolutely, and I'm glad you highlighted that point because while we're saying we're less exposed to the US, for example, right? Like it's all relative to the benchmark and to the index. So while the index's weight to the US in global equities is probably around 65%, our exposure is closer to 40%. So on one hand, you can say, we are very underweight, but at the same time, 40% is still a
It's
big
all a
part
lot.
of the portfolio. Yeah, yeah,
And so for a lot of people, if you said 40% is in the US, they would think, well, that's an incredibly high amount.
It's a
But
lot. Yeah.
as a portion of the global economy and the general index weightings, it is underweight. And that's where again, there's the terminology and different things. With that, I suppose maybe as a lead in terms of weightings and where the valuation leads to and what the dashboard is driving and is maybe in that small and micro cap space a little bit and trying to find like, okay, like where has the appreciation in values not maybe flowed right through to? And maybe you could just give us a little bit of, maybe just first of all, what is a small micro cap sort of investment, and then how we enter those into the portfolio.
Yeah. Yeah, sure. So small and micro caps is, it's all just definitions of the size of the company according to the size of their market capitalization, right? The full value of the company, if you take, the number of shares multiplied by the price of those shares, that's kind of the market cap of a company. Yeah, and then, quite arbitrarily, but like index providers tend to divide all of the market into large cap, mid cap, small caps, and then micro caps. Now, as you can imagine, it's all relative to the size of the market itself, right? So what's defined as a small cap in the US is a mid to large cap in Australia because of the size. So treat everything with a little bit of a grain of salt, and there's definitional nuances there. Now, for quite some time, we've identified that actually both in global terms and in Australia specifically, small caps have been neglected by the market, and we're trading at a discount to large caps. Now, you have to be a little bit careful with that because it is very often the case, and particularly in a Australian context where a lot of the small cap universe is actually small mining companies that are very speculative and therefore that are always cheaper, and they're cheap for a reason. But even adapting for those factors and for those nuances, we still observe that relative to the past, those small caps were trading at a discount. And so that's something that we've had in the portfolio also for a few years now. Within Australian equity, we've gone with a small cap active manager and also with a micro cap. So micro is like, what's smaller than small basically. And both of those have actually done very well this year, in an Australian context. Now, it's our opinion that you have to be careful with things that do well, is because they might not always continue to do well. But it's from what we can tell, there's still quite a lot of attractiveness in that part of the market, and we're happy to maintain those positions. If you look at the global small caps, right? So small companies with a global context, they actually haven't done well in the last year. There's basically two things that really haven't done well, if you think about it from a factor perspective in global equities. One is small companies. The other one is a quality factor. So companies that tend to be a very high quality, meaning less debt, grow their earnings not that fast, but very steadily. That's what's typically defined as that particularly have a good return on invested capital. That tends to be defined as quality companies, as opposed to growth company or value company, right? Now, quality as a factor hasn't done well this year, in large part because the market has neglected the company and focused on AI as a thematic. Now, as it happens, and sorry for this long introduction, but the manager that we have, the active manager that we have in global small companies, is also focused on quality companies. So he's really at the intersection of all the things that haven't worked so far this year. And so we did spend a bit of time at the investment committee talking about it and explaining that. And two observations I made. One was that if everything works well in a portfolio, then that means you're not really diversified, right? And it is at best you want 80% of your positions to work well and 20% to not work well. And this year, from that perspective, has been really good. The portfolio's performance over the last 12 months has been probably above our expectations, and compares very, very well with peers. Now, of the things that didn't work was that particular exposure. Now, when we look at it, it's not that the companies that this manager owns have deteriorated in quality. It's not that they've disappointed investors. Quite the contrary. Like, their earnings report continue to be very strong. It's just that, the market's attention is focused elsewhere, and therefore they've been neglected. So that kind of, I'd say, maybe strengthen our conviction in this manager and in the companies as something that, over the next investment cycle, it could be next year, it could be in 2 years' time, but at some point should do really well for investors.
I think the other point just with those is that it's a dangerous business to be going out and buying a lot of small or micro investments directly yourself. So the process there is using the managers who then apply another filter. So we sort of look from the top down and say, okay, we think there's opportunity in that space. Then go and speak to specialist managers in that area who can then blend together a range of different sectors and businesses in those funds, so we get an experience across the board. So it's sort of diversifying the diversification is how I've always viewed it. Yeah. That's the safer way to do it. Like you're talking about, the little, someone digging holes in the Pilbara hoping to hit something. Like that's what there's a lot of them out there, and sometimes it's gambling more than even speculating. Like, it's very dangerous stuff.
That's right.
Now, sometimes through those funds, they may invest into something like that potentially, but they're doing it with a lot more research and a lot more conviction and a lot more diversification than what we would be if we were just trying to buy these direct. So I suppose that you see these names in there in the portfolios, and again, you can then drill down on them. And if anyone has any questions around what actually sits inside them, then please ask away and please chase us, because it's all there and it's all very transparent for people to know what is actually happening behind the scenes of that. Probably contrary to that, we talk about maybe roll into our direct equities portfolio. So where you are opening up and seeing the directly listed companies. So Mineral Resources is one that I think it's sort of circa about 12 months ago, we started to have a bit of a nibble at and add in a couple of times into that. Yep. Again, it's a lithium, well, predominantly, I think lithium is probably what's driven its downfall back a year ago. And it is a diversified miner from my understanding, but it has other factors. We've been able to do okay out of it. Yeah. And I suppose now your thought is to take our gains and sort of run a little bit. Give us just a little bit of a story on that.
Yeah, sure, absolutely. So, in the spirit of what you were describing, within the context of our direct equity portfolio, we're also trying to diversify in terms of size, in terms of style, in terms of industry, and yes, we will often have one or two stocks in there that are a bit more speculative, that have kind of higher risk, higher return type of stocks, and Mineral Resources was definitely one of those. So we introduced it at a very small weight. And it's a company that, as you highlighted, was well known for its lithium mines operation. It's also a service provider to other mining companies. And then finally, and that's where things became a little bit controversial, is it invested a lot of money into a new iron ore mine. Right, and in order to do so, it had to incur quite a lot of debt. And at the same time that happened, the price of lithium collapsed. And so the company found itself in quite a tight position, with less earnings coming in from the lithium mine and the iron ore mine, which still wasn't operational and requiring more and more investment, right? On top of that, you throw a bit of a governance issue with a scandal, quote unquote, but accusation that the CEO of the company did very early on in the life of the company some transactions that may have been not quite proper. And I'm not
not judgment.
Not judgment. Exactly. This is just the facts, not my opinion. So we thought that, we looked into it, and we thought actually that provided an opportunity where we believed in the strength of the asset, and particularly the iron ore mine, that it was coming online probably 6 months from when we invested, and we thought that the share unfairly beaten down. So we initiated a position almost exactly a year ago to the day, and to our disappointment, we went from bad news to worse. And famously, a certain road, a service road, that That was a key part of the iron ore mine, because you need to not just dig the stuff out of the ground, but also transport it into out of there. That road collapsed and required more investments, and so the share price continued to fall. And that gave us an opportunity to actually, increase our position or rebalance up. And in the last 6 months, kind of everything bad turned to good, right? Lithium prices skyrocketed back up. The iron ore mine actually came into production. Volumes coming from it were like in line with expectations. The company was then able to sell a large part of its lithium activities and to pay down some of the debt, so kind of a de-risking the profile of the company. And the share price rebounded accordingly, and it's been one of the biggest winners in the portfolios so far this year. So as we come close to the 12-month period of time, we thought, maybe that's an opportunity to. We took some risk. It didn't look good at first, but it ended up working out quite well. And I think now is probably time to say goodbye to that opportunity. Take our gains after we've passed the 12-month deadline, which means that clients will get a CGT discount on the gains. There are other parts now that this stock has rebounded and kind of the opportunity that we saw materialized, there are other parts in the portfolio where we'd rather allocate that money.
In simple terms, we're going to take our profit and we're going to run, and we're going to skip out the other areas. So again, there's a few other changes which we will filter through with the updates as they come to, and a couple of trimmings of profit off a couple of, so maybe some of the banking stocks and things. Maybe just as a last point, just a quick, and again, it's probably a business people are aware of, but car sales is one that was looking to come into the fold. Just I suppose, again, a very brief comment on car sales and why now sort of feels like a good timing to add that in.
Sure. So what's now been called the CAR Group, CAR Group, which is the owner of carsales.com.au, a very well-known business to many Australians, always has been a really good quality company, like a really success story in Australia. And one of the rare examples of a company that is successful in Australia, then expanded overseas and continued to be successful overseas, and particularly in America. Expanded into other verticals as well, including boats and on top of cars, camping trail, caravans, exactly. And so that company has always done really well, continues to do well, continues to grow earning and do well for its shareholders. Now, at times, because it's such a high quality company, it's been quite expensive, as you would expect. And we always thought that, the quality of the company was never in question, but the price that we were asked to pay was probably a little bit too high for us. In line with what I was discussing earlier, quality companies in Australia as well have been a little bit neglected. Not necessarily to AI, actually probably a bit more to gold miners, which have been the big winners of 2025. But the reality is that a lot of those quality companies are a little bit less loved. And so car sales is now available at a price that we think is much more attractive relative to the quality of the company, and we're really delighted to add such a high quality company into the portfolio at a price that we deem reasonable.
Perfect. And I think it's nice having a story and people understand it. Like, I think people appreciate the being able to just see the name, understand what it is, and connect to the story. So again, as always, encourage people to ask questions and give us feedback and anything they're not sure about. There's so much data, so much information, and things go through our portals, and I think some of the client-facing stuff that's coming also soon. So again, thanks, JT, as always, for your insights and layman's terms to keep it simple for us. So I appreciate your time and look forward to what happens into 2026. So
looking forward to it. Thank you.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, YouTube, and Twitter at BurkeBrittonFP, or Google Burke Britton Financial Partners to check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening. Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decisions, listeners should consider the appropriateness of any information with regard to their particular objective, situation, or needs, and seek advice from a licensed professional specific to their circumstances. PB Financial Solutions Proprietary Limited, trading as Burke Britain Financial Partners, are authorised representatives of Acumen Financial Planning, ABN 89051208 327, Australian Financial Services Licence 232706.